Hey guys, and welcome back to my YouTube channel. It's Anita. For those of you that are new here, I'm a real estate investor in the UK and have been for the past 6 approaching 7 years now. And today you join me for our October update on the UK housing market. Just a quick announcement before we dive right in. I will now be posting every Sunday and Wednesday instead of the previous Saturday and Tuesday, simply because of my work schedule. So let's dive right into our October housing market update. So unlike the other months, September saw almost no rise in house prices in the UK, indicating a slowdown might finally be here. This is the first time we haven't seen a month-on-month rise in the property prices since July 2021. It's owing thanks to the sky-high inflation rates of 9.9% and also the sky-high mortgage rates, with some owners even reporting a 10% rate on their mortgage. According to Nationwide, in September, the average UK house price was around 270,000. The exact same as August, and this is a rise of 9% from the same time last year, which is lower than the predicted 10% month-on-month rise. And out of the 13 regions in the UK for which house prices are measured, 10 of them showed a decline in the house prices and only 3 of them showed a slight increase, and the ones that showed an increase included London, Midlands and the West Midlands. A recent article in The Guardian predicted that the house prices could fall as much as 10% in the coming year, and this is mainly due to the high mortgage rates, the lack of deals on the market, and a prediction of the Bank of England raising their base interest rate to up to 6%. And what this basically means is that it's getting more and more difficult to borrow money. People are less and less inclined to borrow money at these high rates, and as a result it's becoming more and more difficult for people to buy, reducing the maximum that people are able to spend. The expected decline of 10% in housing prices was also supported by Credit Suisse analysts, who even predicted a decline of up to 15% next year if the markets continue the way they're going. What this means for people at the moment is that if you're looking to sell at the moment, now is probably the best time, because people's purchasing power is only declining, so the maximum that they're able to spend is only going to go down, which means that the maximum price that you're willing to achieve is likely only going to fall in the next coming months. The mini budget tax cut have triggered a sell-off in the financial markets, a rise in the interest rates, a sharp drop in the value of the pound, and the expectation of even higher interest rates. And since the announcement of the mini budget, lenders across the country have suspended the number of mortgages they have on offer, and the ones that they do have on offer have been at extremely high rates. The main reason here being that it's been extremely difficult due to market volatility to price rates, and also in order to curb demand because of the sudden surge in people wanting to fix the rates of their mortgages. So let's now delve deeper with what is actually happening with mortgages. So since the announcement of the mini budget 2 weeks ago, lenders have pulled 40% of the available mortgage deals on the market, and according to Moneyfacts, this is around 1,600 mortgage deals less than they were before, with HSBC and Santander being 2 of the biggest names that have cut deals. So while the mini budgets may have sounded great with the tax cuts and the decrease in the threshold of stamp duty, this has been grossly overshadowed by the massive rises we have seen in the mortgage rates at the moment. According to Moneyfacts, the average 2-year fixed rate at the moment is around 4.86%, which is 68% higher than it was December last year. This has put landlords who have taken a mortgage 2 years ago at a huge risk, because they will now be coming to the end of the term of their mortgage and will be suddenly faced with a huge decline in their profits because of the extremely high mortgage repayments. And this is especially so in areas like London, which have historically much lower yield than the rest of the country, around 5 to 6%. Personally, I've seen the spike in the 2-year fixed going up to 5% and the 5-year fixed going up from anywhere from 5% to 7%, which is astronomical compared to when I compared it a few months ago. And the variable rate of the mortgage I took 2 years ago is even higher at around 7.6% and only predicted to increase. This is shocking because 2 years ago the predicted average variable rate was around 4%. So as you can see, huge rises and a lot of crazy numbers. To give you guys some context of how much these rates have increased, Nationwide currently offers a 2-year fixed at around 5.6%. And in June, this was only 2.5%. And this is almost a £900 increase per month on a house worth around 500,000. So as you can see, the outlook with regards to mortgage doesn't look great, and around 1.3 million people are meant to be coming to the end of their fixed term 2-year mortgage this year, and around 2.2 million people are predicted to be on variable rate. So what this means is that people are likely going to struggle to be paying their mortgage, and household budgets are going to be even further stretched, and people may even likely be forced to sell off their houses, or they may even fall behind on their payments. So with mortgage rates on the rise, what does this mean for rents? So earlier in this year, in July, Rightmove reported a 23.4% increase in the cost of rents in Manchester compared to the same time last year, which is shocking. And this is much higher than the 15.8% we saw in London, and much higher than the 11.8% predicted elsewhere in the country. This is mainly been driven by the lack of supply and in only increasing demand. The number of houses available is shockingly 46% less than the 5-year average. And now, believe it or not, the average agent only has 8 homes to let. And sadly, this is unlikely to change because tenants have been securing more long-term deals and have been staying put and are less keen to leave if the rents don't rise too steeply. Another contributing factor to this rise in rents has been unfavorable tax conditions in the past by the government, forcing existing investors to sell off their properties and leaving less and less rental properties available on the market. If you're a buy-to-let investor, you're probably thinking, what options am I left with? So at the moment, the current 2 best options are to either sell your property in order to avoid paying the super high mortgage rates, and the second option is to transfer the cost to the tenants and increase rents. So as we can see, the future outlook for renters doesn't look great, and the prices of rents are only predicted to rise as more and more buy-to-let landlords transfer on the cost to their tenants. So if you're a tenant, it probably is best to try and secure a deal now with your landlord for the upcoming few years. The Mayor of London recently did say that there might be a potential good news of a rent freeze in very expensive areas like London, where the freeze would enable people to save up to £3,000 over the space of 2 years. This, however, is still under debate and has yet to be implemented, and one of the reasons why the rent freeze has been suggested is that shockingly almost 50% of the properties in London are below the minimum energy band C bracket, which means that half of the houses on the market are not as energy efficient as they could be, and renters who are already struggling to pay rent are going to end up paying even more in electricity bills. Factors like this are what have contributed to many renters moving to houses of multiple occupancy, where they share a house with other renters in order to decrease the costs. And also many of them are being forced to not rent at all and maybe even move in with friends or family. Another trend that we have seen in the rental market is that renters are no longer as keen as they once were to rent 2 to 3 bedroom houses. Instead, what's become more popular are 1 to 2 bedroom flats instead, because of the rising cost. So what about news for landlords? Where do landlords stand among all this? If you're a landlord, you probably have benefited from super low interest rates as well as the stamp duty cuts that we saw during the pandemic. However, now with the sudden rise in interest rates, the amount of profits you actually will receive are going to start to decline. According to data from Hamptons International, the average landlord in the high-paying tax bracket who earns a 6% yield on his property can expect to see a 72% decrease in his profits over the coming year, and all due to the recent hike in interest rates. What is shocking is that they have even shown that if the base rates, which are currently at 2.25%, rise even 0.25% more to 2.5%, the landlord with the 6% yield is likely going to see a loss and will be in the red. The only landlords that might be able to stay in the green and benefit or make a profit are those earning a yield above 7%. So for the average landlord with, say, a 200k buy-to-let property who remortgaged just last month, you're expected to see your mortgage repayments almost double from 3k to more than 5k. So the current advice for landlords who have low yield properties and who are coming up to their mortgage renewal is for them to sell their properties in order to avoid going into the red because of the super high mortgage rates. And rates are not expected to go down anytime soon because the Monetary Policy Committee, which sets the base rate for the Bank of England, is expected to meet in November very soon, and the rates are predicted to only go up to around 3.5% and even up to 6% in 2023, which means that this increase in rates is going to be transferred onto the mortgage lenders, who are going to then transfer their hike in prices onto the consumers. The mini budget announced an increase in the threshold beyond which stamp duty would be charged. In theory, this might have encouraged a lot of buyers who are looking to buy to hurry up and quickly secure a mortgage deal and not have to pay an increased amount of stamp duty. However, a lot of the benefits of the mini budget have been hugely overshadowed by the hike in the mortgage rates. However, if you're an investor with a large cash deposit not dependent on a mortgage, you would still greatly benefit from the increased threshold of the stamp duty. If you're a foreign investor, the recent drop in the value of the pound might make the UK housing market look even more attractive to you because now you can get more for your money. So sadly, while houses here are becoming more and more affordable to UK residents, they are becoming more and more attractive to foreign investors as the value of the pound deflates, and of course also more attractive to people with large cash deposits. While the prices of properties have been predicted to drop to up to 15% by Credit Suisse, it is highly unlikely that a crash will actually occur. And the main reason for this being is the lack of supply on the market. What's most likely to happen is that the prices will just fall and then just stagnate. Well, that's all from me for today, guys, for our October housing market update. As always, thank you so much for watching and for your constant support. I hope you found this video valuable, and if you did, please remember to like and subscribe, and I will see you all in my next video. Bye!